So whenever you bring up the topic real estate, the number one topic that comes up under that category would be interest rates. So if you are curious about interest rates and how that works, this video is for you. So first, let's talk about what interest is. The simplest explanation I can give for what interest is, it is the cost of borrowing money. If, for example, you borrow $100 from your friend and your friend says, hey, I want that money back plus 10% interest, or he may say, I want that money back plus $10, then essentially he or she is charging you 10% interest. So the easiest way to think about interest is the cost of borrowing money. Now let's dive into why the news and the internet and economists talk about interest rates when it comes to housing all the time. So I'm going to give you a brief overview on why interest rates are so important when it comes to purchasing a property. So let's take this house, for example. It's not a pretty house. So let's say, for example, this house is for sale for $300,000. If the interest rate is 3.75%, taxes are $3,000, insurance is $500, then your payments are right around $1,675. Now, if everything else stays the same, but your interest rate jumps up to 4%, look at what happens to your mortgage payment. It jumps up to $1,715. That's $40 extra. Just to put that in perspective, that's probably most people's internet bill. So it's a pretty big deal, even though the amount doesn't seem like a lot. If that interest rate jumps up a little bit further to 4.5%, then you take a big hike in the mortgage price or the mortgage payment, and it jumps up to $1,780, which is $65 more than at 4%. Now, assuming everything else stays the same, so the price of the property hasn't changed. The taxes are going to be the same, the insurance is going to be the same. If the interest rate alone changes, look at what happened to the numbers. So from 3.75% to 4%, which is just a 25 or 0.25% increase, your mortgage payment jumps up by $40. If it goes up to 4.5, which is half a percentage increase, then it jumps up to $65. Now you're probably still thinking, that's not a lot of money, what's the big deal? Well, here's the big deal. Take a look at the numbers at the bottom. Look at the cost of borrowing the same $300,000 at the different interest rates. So if you borrow $300,000 at 3.75% interest, then the cost of borrowing that money is $180,000, which means you're paying back $480,000 to the bank. Take a really close look at what happens though at 4%. It jumps up to $194,000. So that small 0.25% increase jumps up to $14,000 more in interest payments over the life of the loan. Take a look at what happens at 4.5%. It's an even bigger jump. It jumps up $28,000 just from the previous amount. So you're paying $222,500 back to the bank. These are really big numbers, right? You can buy a car for $14,000. $28,000, you can definitely buy a car, maybe two. So they are very substantial numbers that you should pay attention to. And this is the reason why, in a nutshell, economists are always focusing on interest rates. Another really, really important thing to consider, and one of the important things why it's so crucial is, let's say, for example, Karen's buying a house, right? If the bank tells Karen she cannot have a mortgage payment that's more than $1,700, then if Karen gets a loan at 3.75%, she's good, right? She's still under the $1,700 range. But if Karen doesn't act fast and interest rates increase, and let's say the interest rate jumps up to 4%, now that same house at $300,000 with all the other payments the same jumps up to $1,715. And guess what? Karen's out of luck because the bank's cap on her purchase price even though it may still be the 300,000, the bank's cap on her payments per month was 1,700. So now she's outpriced. She can't buy that house. If the rates continue to rise, then it's even further outside of her financial capability to purchase the house. This is why it's so important that if you are a ready buyer and you're able to buy, the interest rates right now, for example, are very low. It is a great time to buy if you're able to buy. The longer you wait, if the interest rates increase, the amount of money that you pay back increases as well. And again, these are substantial numbers. So in a nutshell, this is why interest rates are important. The higher the interest rate, the more money you're going to end up paying back the bank over time, as well as the more money you're going to be paying monthly to meet that financial obligation. I hope this information was very simple and easy to understand. Just in case it wasn't, please shoot me a message or leave a comment below and I will be happy to answer your questions.